Good morning and welcome to A View to 23, a virtual forum on Connecticut and the national economy. I'm Platt, Liebau, the president of Yankee Institute. They call economics the dismal science, and some of the recent headlines have, in fact, borne that moniker out. So, are better times around the corner for our state and nation? We're going to discuss that and other issues with our distinguished panelists. So let me introduce them in alphabetical order. It's a pleasure to welcome Fred Carstensen back to the forum. He's a professor of finance and economics at UConn School of Business and the director of the Connecticut Center for Economic Analysis. He's a graduate of the University of Wisconsin, received his PhD from Yale, and taught at both the University of Chicago and the University of Virginia. He served 3 times as visiting Shelby Cullom Davis Professor of American Institutions and Values at Trinity College. Daniel Gressel is the president and founder of Teleos Management, a global macro hedge fund. He holds a BS in business administration from Ohio State and a PhD from the University of Chicago, where he studied price theory with Milton Friedman. He's worked as a researcher at Chile's, and I don't speak Spanish, so here we go, a Centro de Estudios Públicos, and taught economics in the US and Chile. He also helped author Indonesia's 1980s tax reforms and advised the Chilean government on its privatized social security system. Finally, we have with us David Sacco, who's a practitioner in residence at the Pompeo College of Business at the University of New Haven. David holds both a BS and an MBA in finance from NYU and has spent 25 years in the institutional fixed income business. When he left UBS in 2009, he was serving as managing director and global head of rates and was a member of the UBS Investment Bank Board. He has an active consulting business and invests in startups and small businesses. And now there's probably one more introduction I should make. As you notice, there's a new face, and this year's forum is being run by Yankee Institute's new own director of external affairs, Bryce Chinault. Bryce comes to us from George Washington University Regulatory Studies Center, where he worked in communications and outreach after specializing in state outreach at the Mercatus Center at George Mason University. I'm getting my founders mixed up. He holds a master's in public policy from George Mason and a BA from the University of Wisconsin-Whitewater. Bryce, the floor is yours.
Great. Thank you, Carol. And thank you for those very kind introductions. I think the way Carol set that up with alphabetical order, I think we could probably keep that vibe going. And so for this first part, we'll hear from our panelists where their thoughts are in the local or national economy. And then hopefully we'll have a great dialogue in a Q&A fashion. For anyone viewing via the Zoom link, it should be a Q&A function. Please do submit questions there with anything that you're interested in. I've received a few questions via email as well, and we're also live streaming on Facebook. And if you throw your questions in there, I'll hopefully catch those as well. So with that, we'll kick it over to Professor Fred Carstensen.
Well, let's start with, I don't want to say anything. It's very unstable right now in the world because of we know that the situation in Europe with Putin's invasion has destabilized a lot of energy markets and food markets, though things on the food side seem to have largely recovered. China had enormous disruptions because of its COVID shutdown policy, which they are now softening. So we might be getting some improvement in that. Inflation, of course, is a global phenomenon, though that also seems to be mitigating now. That was driven by supply chain issues. The United States looks to be the best performing of the major economies. And Friday we had a very robust jobs report. The economy continues to generate a lot of new jobs, and the number of open positions for which companies are advertising is still significantly more than the number of people that are unemployed. So and our GDP numbers looked good. And there's even now some discussion that the Fed might actually be able to begin actually cutting rates in 2023, because it does look like inflation is getting under control. So, things sort of look reasonably good with a lot of question marks in a kind of a turbulent world. But our primary focus ultimately is going to be on Connecticut, I think. And the looking back, to be very quick on that, we've never recovered from 2008. Our payroll employment in the state of Connecticut is still below where it was, not only pre-COVID in 2019, but also March of 2008. And more worrisome is that gross state product, the equivalent of national GDP, but we call it gross state product, is in real terms, inflation adjusted, is below where it was its previous peak, which was actually in 2007. Because what happened in Connecticut, actually, this is a long-term phenomenon. With the end of the Cold War and the collapse of the Soviet Union, the Pentagon cut back on spending enormously. Connecticut was second only to California for the amount of per capita defense spending in Connecticut. We also did not have a diversified economy like California. And so we had the worst recession in the country. We lost 164,000 jobs in the early 90s. That was when we got the income tax under Weicker, a big state deficit. Electric Boat was probably the worst hit. It had over 30,000 employees and went to 10,000. Eastern Connecticut went into a swoon, and it was the Mashantucket Pequots and then Foxwood and the gaming, which restored employment in Eastern Connecticut. We created relatively few jobs, and progressively we produced fewer and fewer jobs after the initial recession, and then after the dot-com recession, and then after 2008, we didn't recover at all. And a lot of that had to do with this collapse of the defense demand. And at the same time, 1992, 1983 is when the internet became available to the public. And again, Connecticut just did not see the importance of the emergent, data-driven, digitally dependent economy. And so even today, we have the weakest IT infrastructure in the Northeast. We don't have significant data centers. We have high-speed fiber optic cable that runs between Boston and New York with no off-ramps in Connecticut. So it's like having I-95 with no exits or entrances, which, if we all had to drive on Highway 1, it would be a very slow trip. So that's backward looking. So the state economy has been anemic, but people who live in Connecticut took a lot of jobs out of states. About 140,000 additional Connecticut residents took jobs out of state. That's the net increase. So if you look at employment in Connecticut of Connecticut residents, it actually looks pretty good. The problem for the state is that when you work out of state, you pay your income tax out of state. And so Connecticut is much weaker on its tax revenue. We also, DRS is seriously understaffed, and we can talk about that later, and is probably missing out on as much as $1 billion a year on tax revenue that should be collected. So we've got some serious issues where we are right now, but looking forward, it actually looks like we may be on a path to recovery. Thanks, ironically, to defense spending. Electric Boat is ramping up to do 2 Virginia-class subs a year from 1, and is doing the new Columbus, and it's going to increase net employment by over 9,000 positions over the next several years. It's about an 80% improvement. Sikorsky did not win against Bell, but it does have a big pipeline of demand for the Blackhawks, which is what the military still is dependent on. And there are other contracts potentially coming down the pike. So Pratt & Whitney also has got, with Boeing, has got some contracts. And of course, in civilian aircraft, the Pure Power Gear turbofan is taking Pratt & Whitney back to #1. And these are types of development which are much more valuable than what we've been seeing. What we have been seeing was job expansion in things like elder care, logistics, tourism, hospitality. They have very weak multiplier effects. You know, when you build a fulfillment center in Connecticut, there's no supply chain associated with that. You know, with Pratt & Whitney, there are literally hundreds of companies in Connecticut that feed off of that growth. So the kind of growth or kind of investments we've been having in Connecticut are kind of the weakest ones, which is why we haven't had the recovery. They also are, those sectors are all ones that also don't pay very well. So we've had a decline in household income in Connecticut because of the kind of jobs we've had. This new largely defense-driven, not exclusively, is much better quality employment. The state has also ramped up workforce development training very dramatically, which is great because we've never really had that in the past and the scale that we have it now. So we're responding, I think, more constructively. And then in Wilton, we have a $200 million 1,000 new jobs associated with ASML, which is the Dutch company that is the leading producer in the world of chip production equipment. That's a very, very encouraging development. So the jury is still out on whether we're going to make this transition and get a more positive trajectory, but it's the most hopeful situation that I've seen for the state, literally in nearly a decade.
Okay, great. Thank you, Fred. We could jump over to Daniel then. And I know Daniel's got a national outlook on a lot of things, and we're excited to hear from him today.
Okay, thank you, and good to meet everyone out there. Before I go to national, I just want to just briefly comment on Connecticut. If Connecticut spends, the last time I did the calculation, which might be a couple years ago now, spends about $50 billion a year state and local. If we spend at the Florida rate, we would be spending $30 billion state and local. That difference of $20 billion gains us nothing. That's the reason people are leaving the state. That's the reason the jobs are gone. That's the reason we have a bad place to do business, raise a family, and have a life. And that's the reason people are moving out. So if I were the governor of the state, I would be cutting spending, and I would probably get rid of the corporate income tax, which is the cheapest, fastest way to cut the tax burden on the people who are leaving the state. Now, allow me to move nationally. And my old buddy, my old professor, Milton Friedman, is turning over in his grave. I am going to share a screen and show you what our wonderful Federal Reserve is that working, Bryce?
Yep, okay. That looks good.
So there's something called the money supply, which if you know what that is, it turns out that when you increase it, you end up with inflation. So in Milton's words, inflation is everywhere and always a monetary phenomenon. So here I have money supply growing pre-2019. It varies between a low of about 2 to a high of about 10. It averages 5.7% a year for the 20 years before COVID hits. Along comes COVID. The Fed, along with a lot of other people, panics, prints up a lot of money, increases the money supply by 27%. Then, as the inflation shows up a year later, they're still printing money at the 12-15% rate. You can see that over here in 2022, beginning of 22. And you hear these insane babbling from all of Washington about how everything is a bottleneck and how everything is temporary. And this is all transitory. Whereas those of us who are monetarists are looking and saying, well, excuse me, you increase the money supply by 27%, unless you get rid of it, you are going to have inflation. So now we fast forward a little bit to where we are today. And we discover that since March of 2022, M2 is growing at a negative 2.5% annualized rate, which basically, if we hold that for a year, that'll be a new low record. That takes us back to the Great Recession, and I'm not talking about the recent one. I'm talking about the 1930s recession levels of money growth. Since June, PPI, Producer Price Index, is growing at minus 4.5%. So that means it's shrinking. And the CPI is running at a 2.8% annualized rate since June also. So what do we have? We have money supply collapsing. We have the Federal Reserve thinking that it's looking in the rearview mirror, not realizing that money is a leading indicator, not a lagging indicator. So they are raising rates in the face of a potential recession, while they should have stopped at what I'm going to stop sharing. They should have stopped at whatever the rates were in the market in the end of March when money stopped growing. That's when they should have stopped, which meant they would have stopped at about 3% instead of their 4% and soon to be 4.5% and maybe 5%, or who knows where they're going as they keep looking in the rearview mirror. Now the geniuses that are running the place are going to then announce to everyone how smart they are when the inflation stops, and they'll say, look, we stopped the inflation, without including the paragraph before that we caused by incorrect monetary policy. Look how smart we are by stopping this inflation that, was really transitory and temporary. The whole thing was caused by them. Okay. Now, some people from the right will say that the inflation was caused by excess government spending. And the answer to that, in my opinion, is that is not true. The inflation was caused by printing too much money. The drop in real wages and the fact that people are poorer was caused by the government taking the money and throwing it away over the last few years. So that's what caused a drop in real wages, is the waste that came out of Washington and perhaps out of the states too. That's going to depend. Now, let's ask the question, with a minus 2.5% growth or shrinkage in the money supply, will we have a recession or not? Now there, the jury is out, okay? So if you're a good old monetarist, you're going to sit there and say, of course we're going to have a recession because money is shrinking, the Fed is raising rates, and everything is going to hell in a handbasket, and things are just going to get worse. So I'm going to actually say this one is a toss-up for me, and there's two reasons. The first one is, normally when we have a recession, we have prices growing like this, and we have wages more or less keeping pace with them. The Fed slams on the brakes, prices keep going up. No, excuse me, wages keep going up, prices roll over, and workers can't get a job. You end up with a recession and increase in unemployment. This time is different. This time, and I haven't seen this on any of the TV shows yet. I look, watch CNBC, watch Bloomberg, I watch for any economist. Very few will even talk about the money supply, let alone what I'm about to say. Real wages have gone down. We know from economic models that if you cut real wages, you don't get a recession, because people keep their job. And if that's your definition of recession, people keep their jobs. When everyone takes a pay cut, they don't lose their jobs. So that's one of the reasons why the employment situation keeps looking good, is because people have taken between a 5 and a 10% pay cut, and therefore firms are able to keep hiring and keep things going. So that would be reason number one. Reason number two is the banks aren't bankrupt. Let's take the 2008 recession as an example. So in 2008, you came to the bank, you want to buy a house for 100. The bank gave you a loan of 95. By 2008, the loan is worth, the price of the house is down to 80. And so the bank is sitting there looking at a minus 15 on its balance sheet, and the bank is essentially bankrupt. I had a neighbor from UBS, which is a Swiss bank, and this is December of 2008. He said, oh, we just wrote off $15 billion. I said, oh, that's nice. Do you have any more to do? He said, oh, we got another 150 to go, another 150 billion to go. I said, well, why don't you write that off now? He said, oh, we can't do that. We'd be bankrupt. I said, don't you think you already are bankrupt? He said, oh, we're not allowed to say that. I said, oh, okay, well, that's nice. So that's why the 2008 recession was so deep and so steep, is because the banks have made loans and against assets which lost their value, and the banks essentially were all bankrupt and they couldn't make a new loan. Look at the situation today. Today, I start with I go to buy my house at 100. I get a loan more like 80 to 90, not 95. And the price of the house has gone up to 120. So all of a sudden the banks are sitting around saying, well, you know, I'm not bankrupt because people are making loans and everything's still working. Then you go over to the people who are borrowing the money and the real reason the money supply is not growing. Let's take a typical example would be someone doing a multifamily development in an apartment complex. They show up at the bank and they say, this is 2 years ago, they say, okay, we're going to buy this thing at a 5% capitalization rate, meaning on every $100 they put in, they're going to get $5 of rental income. We're going to buy it at a 5% capitalization rate. We're going to borrow money from you at 3.5 from the bank, and it's a 70% loan to value. So therefore, we're going to be able to pay our limited partners, our equity holders. We're going to be able to pay them 7-8% interest or on their money, and we're probably going to have a 10-15% internal rate of return. Okay, so that's 2 years ago. Now they show up with the same project. Now they have to borrow at 7.5%. The bank sits there and they start to laugh at them and say, well, this ain't going to work. We're not going to lend you the money because it's not going to work. And so all of a sudden, you have this very interesting economics experiment, which is inflation formation or inflation expectations formation. There's two schools that are competing, and we've found out which school won. One school is the rational expectations school. That school says that future inflation is what one would rationally expect. And in this particular case, the Federal Reserve, which does control the money supply, said, we're going for 2%. We're going to do whatever it takes. In that world, future inflation is 2%, and that's what you expect. An alternative view of how inflation expectations are formed would be adaptive expectations. And that would mean I look at the past, and all of a sudden I see 8% inflation. Plus or minus a point from that, that'll be next year's inflation. Now, let's take those two views of the world, walk over the banking system and say, okay, I want to take out a loan. Well, the bank says your rent rolls are only going to go up at 2% a year because that's what the Federal Reserve says it's going to be. He said, I want to use adaptive expectations and say 7. The bank says, no, we're not going to give you a loan based on that. Therefore, we have the whole economy grinding to a halt. That's why the M2 has stopped growing. In fact, it's shrinking as people pay off their loans. And it also means that on the back end, when the Federal Reserve takes their blinders off and stops looking at old data and starts looking at forward-looking data, I don't know what day that's happening, but the day that happens, they're going to say, we're going to cut rates. And the market is kind of understanding that. And what will actually end up having happen will be, there'll be a whoosh, reversal. I'm guessing around June of next year is when this will happen. And the Federal Reserve will start cutting rates, and my own expectations will end up back at a 1% Fed funds. We'll end up with a stock market boom. We're going to end up without a recession, both because the banks are not bankrupt and because everyone's taking a real wage cut, and things will be okay. And so that's kind of my view on what's going to be happening in the future. And I would love it if someone in the Federal Reserve actually would ever look at their own money supply data. That would be nice. And instead of talking about transitory this and bottleneck that, they would actually look at what they do for a living. But by their not doing that, it provides people an opportunity to make money in the markets. Anyway, thank you.
Glass is always half full, right?
For me, I'm a perennial optimist.
Yes. And yeah, I would have loved to have been in the classroom for Milton Friedman's last course. And thank you for what would have been likely his insight here today.
Oh, he'd be going crazy right now. If Milton were alive, he'd be bouncing off the walls because he couldn't believe we printed money at 27% and now we're at -3. We went from 20 positive. What are you guys doing?
Yeah, that chart. I remember when the M1 and M2 started spiking. It was just it was jarring, the amount of increase, hockey stick. But we'll shift over to David Sacco, who's a first-time participant in our forum here, and we're joining us from the University of New Haven.
Well, thank you guys for having me. I am I'm honored to be part of this panel because my colleagues know a lot more about economics than I do. My experience is all in the markets, and I spent most of the last 30 years waking up every morning, wondering what the Fed was going to do and how it was going to impact the markets that I traded in, and many times being physically ill before I even got to the office to see how bad my positions were doing. But the last 3 years, it's been a lot more interesting because I'm sort of looking at it from the observation perspective and talking to students about it and trying to explain it to them. And, when you sort of step away from it and try to explain it, it's even more insane how the market reacts to these things, and what information it gives us. And I'm always fond in my classes, but one thing I like to do is when we're talking about markets is pull up a story the day that the Dow goes down 500 points and what the headline explanation is. And then the next day when it goes up 600 points, there's a different explanation about why it happened. And I'm like, what happened in the last 48 hours that makes people think that their opinions have changed? But, Daniel and Fred have both made a lot of great points. This is all about the Fed and what they're doing and how they're doing it. And, having been involved in financial markets, and Daniel, at some point, I'd love to talk with you offline about who your colleague at UBS was, because someone who said that had to be someone that I must have known very well, as we lost $50 billion doing some of those things. But I want to start with, one of the points that you made, which is the health of the banking system, right? And to me, that's, the biggest difference. I don't know what's going to happen with the economy in the next 12 to 18 months. I've seen enough periods like this over the last 30 years where there have been different outcomes. But, the point is, we just want to kind of look at the markets to get insight about what investors are thinking and what markets are thinking. Because, one of the things that I learned back in the good old days was, if I had the economic data, if I knew what the Fed was going to do before they announced it, I still could manage to lose money, right? Because it was more about how the markets reacted and what people's expectations were, and a whole bunch of different circumstances. So I agree with Daniel in the sense that because the banking system is healthy, right? What almost caused the world to completely melt down back in 2008 was, all of the things that we talk about: real estate prices, subprime mortgages, but essentially it was the fact that the banks and the banking system came close to, it stopped functioning, right? Because at some point in that process, people were not willing to lend money, even if you gave them US Treasuries as collateral, right? So, and therefore, the levers that central banks use, right? They use the banking system to try to manage that, and that, was effectively shut down to them. So we had this, last resort scenario where the governments had to step in. That's not the case now, right? That wasn't the case back in the early 90s when we had another real estate crisis. It wasn't the case in the late 80s when we had a stock market meltdown. So, I don't think we're headed in that direction as long as the banking system is healthy. I also agree with what Daniel said about the Federal Reserve is just reactive, right? I mean, literally all you need to do is go back and look at the headlines from 12 months ago, and it would almost seem like a skit from The Onion if you sort of played some of those comments now, right? About where we are and where we were then. And I will share one chart that I want to kind of talk about, which is taking a look here at 2-year yields, right? So here's, this is no, this is not the 2-year yields. This is the GDP. Here's the 2-year yields, right? So here's the 2-year Treasury rate for the last 50 years or so. And, this, sort of covers most of the period of my career in the markets. And when I started out back in the mid 80s, this was sort of normal, right? We had 2-year yields, for the most part up at around 5%, bouncing up and down based on what was going on in the economy, what the Fed was doing. And then, we had the tech related crash in 2000. In the late 90s, and then we saw rates go down, to quite a low level. And then, the Fed went through this period where they tried to normalize rates over this period, but they did it in a very deliberate way, right? I mean, you guys, I'm sure, remember, they basically increased rates 25 basis points every meeting for, a couple of years. And to me, what that resulted in was the market mispricing risk, right? And then, that I'll argue that had as much to do with 2008 as anything else. So, the point is, what's going to happen to the economy? Well, we're now, sort of getting back to a point where rates are more normalized after, this roughly 20-year period where they weren't normalized. So it's going to be interesting to see how the market reacts. But I am, pretty comfortable that because the banking system is healthy, even though the Fed is usually going to get things wrong. I mean, I do appreciate the fact that that Chairman Powell is talking about, slowing things down and maybe taking a pause to see what happens, right? Because that's the most prudent thing that they can do, right? There's a lag in any monetary policy. They have to be able to predict what's going to happen 6, 8, 12 months from now. And there's so many other dynamics that are changing in the global economy that you sort of have to see how these things filter through and what impact they have. So I'm glad they're being prudent. I think he's saying and doing all the right things, which is they're going to be vigilant, and they're going to watch things and see what the data looks like. But I would agree with what most of my colleagues said. It's just we're at a period of uncertainty. I think it's a more normal situation in terms of where the banking system is and the ability of central banks to do things. But we've also got this problem that's kind of endemic around the world in different economies. If you look at the charts of, and we just pull this one over for a second, this is global government bond yields, right? And you can see this is the US yield curve up here. This is Europe and this is Japan. Obviously, what's missing here is China. But, the market is telling you that, at least in the opinion of where they've got interest rates now, the US economy has the best prospects. Europe is relatively stagnant, and Japan is still in the same demographic mess that it's been for the last 40 years or so. I'll sort of conclude my comments by saying I learned a lesson about forecasting a bunch of years ago when I was on national TV and I was asked to forecast where cryptocurrency was going to be in a year from now. And my thought bubble said Bitcoin's going to be somewhere between 20,000 and 150,000, which turned out to be right. But of course, what I blurted out was 150,000 because, that was going to be the great soundbite, and I got proved wrong. So I'm not sure where the economy is going to be a year from now. But I do think that, as much as the Fed has been wrong, and they usually are wrong because they're always sort of reacting, right? I mean, I have this conversation with colleagues of mine where the Fed has to, do one thing and deliberate one way internally, but they always have to portray a positive message, right? Because the message they portray is so impactful on the market. So I always take what the Fed says with the grain of salt. And again, one of the things I always tell my students is that anybody who tells you where the market's going to go in the future is obviously lying to you, because we don't know where the market's going to go or where the economy is going to go. So, 40 years of thinking about this stuff has sort of led me to the conclusion of, let's just watch what happens, see what happens, know that there's so many things that have changed in the last 2 years, let alone the last 10 years in terms of productivity. My colleagues have talked about supply chains, right? We've gone in 10 years time, we've gone from just-in-time supply chains being the greatest thing in the world to now realizing that we need to have some more slack in that system. I don't even want to think about on the positive side, I think about the productivity gains that were accelerated because of COVID, right? Because of how we've changed to sort of remote work and how much more productive that will make us as economically. And then of course, the part of the economy where people have to actually show up to work every day, how much that was devastated. And then could focus on specific sectors, what's going to happen to commercial real estate, right? So, over the next 10 years, we're going to see a lot of big businesses who spend a ton of money on commercial real estate. And as those leases expire, my prediction is that a lot of them are not going to get renewed, right? So, all of these things are happening at once, and it's sort of fascinating to watch it. I'm a glass half full guy, so I think we'll navigate our ways through it. But it's a big global economy, and there's a lot of variables taking place, and it's going to be interesting watching them and explaining to them. And I love hearing from experts like the ones you have on the panel here, because they are way smarter than I am.
I wanted to make 4 quick comments.
Yeah.
2 about the state, 2 about the national situation.
Sure.
At the state level, oddly, the Connecticut has a larger share and is retaining a larger share of young adults than any other state in the Northeast. So we have a very much improved labor market situation in terms of our ability to both retain and even attract companies. We'll see how that plays out. Obviously, the Northeast as a whole, demographically, we're aging and so on, but at least Connecticut is kind of an exception at least right now. The second thing is that in spite of the reputation about tax levels, according to Ernst & Young, Connecticut has among the lowest corporate tax rates in the nation. It's been ranked at 47th, 48th, 49th in terms of the tax burden on corporations, not on pass-through small business and so on. So it's not clear that the tax environment actually plays as much of a role in what's going on in Connecticut as other factors. I mean, the state failing to make critical kinds of investments, issues with higher education and so on. That's on the state level. At the national level, the market, which is the collective judgment of investors, says that inflation is going to come down dramatically. I just checked, the 10-year treasury is currently at 3.45%. That says that over the next 10 years, the market thinks that inflation is going to be down to the 1.5% to 2%. That's the collective judgment, is that it's going to work. Perhaps even more important, if you look at the premium that's charged for investment grade bonds, which is called the risk premium or the default premium, it's below 2%, which says that the market also does not think that our companies are at any risk really for default. So the market says, A, we're going to address inflation effectively in the relatively near term, and that we're not going to go into a recession. Now, the market is often wrong, but that said, that's what the data says as of today, as we're talking.
Okay, great. So thank you for all that. And going forward on the Q&A, if you guys have questions of each other, by all means, please do. I'd love to have as much dialogue as we can. And thank you all for those remarks. And again, for anybody that wants to submit questions, we've gotten a couple over the Q&A function. Please keep sending those in. We'll try to get to as many as we can. I didn't know. I guess I should have known that the Fed was going to be such a topic. And Fred, maybe you'll appreciate this, or maybe everybody. I once went to the Halloween party on State Street in Madison, Wisconsin, dressed as Ben Bernanke, and it wasn't all that great of a hit. I was handing out funny Monopoly money, and most people didn't get it. But I thought it was pretty great. And I think Fred had to step away for just a moment. But so I was recently at here in Newtown, Connecticut, where I'm at. We recently had there was a tree lighting and festivities, and I was chatting with just the folks that I know here in town around a bonfire, and the perspective that people had on the economy, when I asked them, hey, if you were going to ask a question of a group of panelists on the topic of the economy in Connecticut writ large, what would you ask them? And the response organically for each of them was, when's it going to give? There's just a sentiment of how have we had such inflation? How have we had such job numbers the way they are, and the economy isn't giving? So I guess maybe just a response from that any of you might have. And then maybe on top of that too, where do you guys go for your data? I know that's something that Fred's brought up, that in the past where state level doesn't really provide all that great of data, you have to go to the feds. So just maybe that sentiment of I think there's a lot of people that feel that sentiment. When's it going to give? And then two, where would you guys go for data to make a case in the presentations that you have today?
Well, I'll go at this first. I don't think we're gonna have a recession. I'm actually with Fred on that point. I do think the inflation rate's coming down. I'm finding it a little ridiculous that the Federal Reserve doesn't see the same thing that the market does. So if were I on the Fed, I would be voting for no more rate increases. And the reason before I said why I don't think we're gonna have a recession is everyone's taking a real wage cut, and the banks aren't bankrupt. So therefore, that lowers both of them lower the probability of a real recession. I'd like to comment briefly on something David said before about lower interest rates in the past, where they came from, and I have a totally different view of where those unexpectedly low interest rates came from. And mine comes from what happened in India and China. I took about 500 million people from each country from subsistence agriculture and put them to work making $10,000 a year, say. But neither India nor China have a good social security system or a safety net. So those 1 billion people showed up working in the world traded economy, and they had to save for net, they were saving for retirement. So that lowered the real interest rates around the world as this new group of 1 billion people showed up and said, what am I gonna do when I retire? And the answer is I have to work for myself. Before, when I was a subsistence agriculture person, my kids would take care of me. And now my kids aren't gonna do that now that I'm working in a factory. So I think that actually explains the lower interest rates. Now, as we go away from being more and more globalization, I might be wrong on that one for future real interest rates. But that's, I think, a good explanation of the past. So we're not going into recession kind of guy, and I'm buy the stock market and buy the bond market right now. So that'd be me.
And Daniel, I don't disagree with what you just said either. I mean, I think that there's, sort of a confluence of things that have happened over the last 30 years. And one of them is this insanely unique place that dollar assets have around the world, right? I mean, I kind of often tell my classes, treasuries have become what gold was for most of history, right? And investors around the world, look, I grew up in the, environment of, and I still believe that, at some point debt bubbles have to give. But as long as the rest of the world is happy buying treasuries at these levels, and it's looked at as the gold standard of assets, this could continue. I mean, I think thankfully we've disproven modern monetary policy over the last year or so. And we'll always come up with some new reason why it's happening. But, at the end of the day, you guys are right in that, it's money supply, and then it's just supply and demand when we look at individual things. And right now in the US bond markets, there's a lot of demand for dollar assets, exactly for what you said. There's wealth being developed around the world, and people feel it's the safest place to invest their wealth.
Okay, great. So we've had a couple questions come in here.
Yeah, I wanted to actually, that first one, if I can jump
please.
in, Bryce.
Yep.
There is this mythology about the cost of state government. And I say that because what's relevant is the cost of all of the levels of government. Connecticut has only 2 levels of government. We have the state and we have municipalities. We don't have counties. We don't have other things. Florida has, depending on where you live, it might have 7 levels of government, state and local. It's got school districts that are separate taxing authorities. It's got municipalities. It's got sewer districts, all kinds of things. So the appropriate comparison is not state spending. It is aggregate public spending, state and local. The last time I looked, Florida spends a larger share of its state GDP on government than does Connecticut, because they have all these other units of government. So the correct comparison is that. And in fact, in terms of employment, Connecticut ranked in the bottom 10 states in terms of the number of public sector employees, again, state and local, per 10,000 population. So, and Connecticut is odd in some ways too. One of the big liabilities the state government has is that the state government undertook to fund teacher pensions. Most places don't do that. We have a very odd circumstance where, it's the state that funds local teacher pensions. So the state assumed a tremendous amount of liabilities that are not true in other states. Again, you have to do the correct comparisons. State looks like it's got serious unfunded liabilities. But if you look at other states and you aggregate state and local liabilities, it turns out Connecticut, it's not that we don't have a serious problem. It turns out that it's a problem in lots of states. It's just that where the unfunded liabilities reside is different in other states. So you have to make the correct comparison on that level. That's not to say that we don't have some serious issues in Connecticut. But one of the ironies is that one of the reasons that we have some of the issues we have is that we're seriously understaffed in many of our agencies, particularly Department of Revenue Services. We don't have enough auditors. We're doing about 1/3 of the tax audits that we should be doing. And that's on testimony from DRS itself. And their estimates that we may be under collecting sales tax and income tax by $1 billion a year. So, there are issues that need to be addressed in Connecticut that would, speak to some of these concerns.
Just to bring back my old buddy Milton Friedman, he always said that the burden of government is not the tax burden. The burden of government is what they spend. Now, I could very easily have done these calculations incorrectly. I thought I did total state and local spending for Connecticut at 50 billion, and this is a couple years ago, and the Florida per capita equivalent would have been 30. I wouldn't do it as a share of GDP, I would do per capita. And at the end of the day, it's the case that people are moving from Connecticut and they're going to Florida, and it's not clear that things are so good. My first guess would be the reason they're doing that is because their life will be better in Florida than their life would be in Connecticut. That would be my first guess as to why they're moving. And I would, being an economist, I would of course say that that was caused by the whole panoply of policies that the government is providing. Are we getting our money's worth? Do we really gain anything by having gold-plated pensions for teachers, policemen, firemen, government employees? Do we gain anything by paying someone 46% above above what we think are calculated as the free market wage for this equivalent person? What are we gaining from all these things? And because we're obviously paying for them net. And once again, Fred is obviously in the business of knowing about Connecticut data, and I'm not. So I'm going to defer to that. But it is the case that people are leaving Connecticut and going to other states. And they frequently say it's caused by the tax burden and the regulatory burden. And so I'm gonna go with that in the absence of my having done the data myself.
Yeah, well, so maybe on that we could try to linger there, and by all means, David, if there was anything that you wanted to add there as well. But Fred brings up a report by Ernst & Young EY where their rankings have us a little bit lower. But when I look at some other sources just on where we compare to from other states, I know the Tax Foundation has, for instance, Connecticut at the 49th high, the second highest tax burden in the nation, just behind New York, and an aggregate burden at the state and local level of 15.4%. CNBC, when they do their updates every year on cost of living or cost of doing business, in their latest update for 2022, Connecticut was 43rd and 45th respectively, I believe, based on their update. So I guess I'm kind of curious, Fred, where you maybe to elaborate a little bit more. I know we had a little bit of exchange over email too about why you think that burden might be, why maybe Ernst & Young gets that right, whereas Tax Foundation, CNBC get it wrong. And maybe a thought that I had when I was reviewing the report a bit was, is that because of the type of industry mix that the tax code is incentivized to exist in Connecticut? And so it's there would be more growth, or it is a higher burden, but it's shifted the type of industry that we have, and it's catering maybe more towards bigger financial services and insurance agencies versus a broader growth within the economy. And how come that might not match what posted rates are? Does we go just off posted rates are?
Yeah, I mean, it's you have to look at the specific things. I mean, we tax financial institutions on the basis of the amount of business they actually do in Connecticut, not on their aggregate. And so a company like Bank of America, which is headquartered out of state, but does a lot of business in Connecticut, its tax burden actually went up fairly significantly when we went to what's called single factor. We did the same thing for ESPN. We did single factor for its tax burden so that it would keep their studios in Bristol. They made a $600 million investment a number of years ago in expanding their studios in Bristol rather than setting up headquarters in another state, because we were given single factors. So you have to disaggregate it and look at it. And Ernst & Young is looking specifically at corporate. It's not looking at LLC and pass-through entities. It's looking specifically at companies that are organized at the corporate level. illegally, and their tax burden is relatively low, and there's little indication from I've talked with people involved in the tax accounting area and so on, and the big businesses, the corps are not. This is not an issue for them. They're also very shrewd about how they, manage their tax burden anyway. The other thing is, one of the ironies about like the tax foundation thing is that if you live in Greenwich or in Westport, you got a very, very low property tax burden. You've got mill rates that are in the low double digits. And if you live in Hartford or Waterbury, you have mill rates that are in the high double digits, 70, 80. I mean, it's so the irony is, and we have this from our tax incidence study, that the lowest income households in Connecticut pay over 20% of their income in taxes, whereas high income households are only paying 4 or 5%. So you have to disaggregate it. And so one of the ironies is, yeah, we're a high tax state, especially if you're poor. If you're wealthy, you live in a low mill rate town. You have excellent schools, absolutely superb schools. You have a lot of cultural institutions. You have a good quality of life. So Connecticut is a very odd, we have probably the worst income inequality in the country, or close to it. And so we have, there are two Connecticut's. There's the wealthy Connecticut in these towns, high quality of life, also very restrictive zoning often, so that the cost of housing is a serious issue in Connecticut. We do not have worker housing in many ways. So again, it's like answering the first question is, you have to disaggregate it and look at some of the dynamics. We're also, the reason the property tax thing is so important is we are among the most dependent states in the country in terms of property tax. About 40% of our public sector is funded through the property tax, but the property tax is enormous inequality on that front. In fact, the CT Mirror had an excellent series that was comparing Bridgeport with some of its near neighbors in terms of its property tax issues and sort of where they were. So it was, we have, I was going to say that part of the issue in Connecticut is we were an enormously successful state. We were a very wealthy state, beautiful location. And 1980s, we were doing the average like 12 to 13,000 housing permits per year. We're now at about 4,000. And in the 80s, those were single family. Today, most of the permits are multifamily rental. So we're talking about, a tremendous shift in the nature of the economy. But we came out of that period of enormous success. So it literally ran, for over 100 years, into the 90s. And in many ways, we're very complacent about how we had to respond. And it's taken us, I think, 30 years to begin to confront the reality of how to make Connecticut more competitive. And, as I said in my opening comments, we seem to be beginning to address that. So, I think there's some real hope our trajectory is going to improve. The jury's still out on whether we're going to carry through on that effectively, but at least in the short term, it's looking better. But, I've referenced some of the underlying challenges that we still face.
Yeah, David, did you want to jump in? There was good back and forth.
I mean, again, I'm sort of a novice to the economic part of this, but when I think about Connecticut, and again, as someone who sort of, grew up in the financial business and is very New York City centric, as I've been more involved in these issues around Connecticut, you've got this problem that we're sort of stuck between Boston and New York, and what is our identity? Connecticut basically was a Midwest manufacturing state, right? I mean, that's what we were 50 years ago. And, so we can sort of look, at those states that had those same problems, and then what they've done to sort of rebound from that. And, again, when it comes to the data, the one thing I learned in my career at the financial markets is that everybody can create data to tell the story that they want to tell. So that's why you'll see conflicting data. I mean, most of the data that I've seen, and again, I'm not expert enough to actually delve into the sources, just talks about Connecticut from the tax and regulatory standpoint as being somewhat crippling to businesses. And anecdotally, if you look at places like South Carolina, like Ohio and other states that have, taken a more business-friendly approach. But, the other problem we have in the US is that we've got these 50, somewhat artificial economic units, right? I mean, no country in the world has the problem that we do, where states are cannibalizing business from each other in a way that is terribly unproductive. I mean, again, not to get too caught in the weeds here, but Fred, your point about the school pensions in Connecticut is a good one. Look, I am as small government, I am Milton Friedman, and I believe in the guy who said, make it small enough so you can drown it in the bathtub. But the way we do teacher pensions in Connecticut is insane. I live in a really nice town, Darien. My kids went to great schools, right? Teachers in Darien get paid a heck of a lot more than teachers do in other towns. And the fact that pension system is subsidized, and taxpayers all over the state are subsidizing what teachers in Darien get paid in pensions is insane, right? I mean, it's, so there's, that issue again, and I'll pretend like I'm an economist for a second, of these externalities and how we deal with them, right? If we could address some of those issues and really think about the intention of these policies and what the outcome is, and again, go back to 2008 market crash. The government thinks it's a great idea for everybody to own houses, so they enact a whole lot of policies that lead to exactly what you would expect to happen with the 2008 mortgage crash, right? So, sometimes we have to think about the unintended consequences. I mean, I'll disagree with Fred in the sense that, now that I'm part of a bureaucracy, that I've been working for a university for 3 years, and again, bureaucracy exists in the private sector too, but that level of competition and that level of accountability, that's, look, you in a bureaucracy, you can be incompetent and have lifetime employment, right? And that happens in state governments, it happens in universities, and we revert to the mean in a bureaucracy, and that that lack of efficiency, to me, still means that every dime we spend in the public sector is going to be inefficient in terms of its economic output, and anything you can do to sort of push that into the private sector is going to lead to more efficient and better economic outcomes.
Okay.
And although I hate to add to an amen chorus of any sort, I would just commend our listeners and our participants today to some of the studies Yankee Institute has done on some of these tax and regulatory burdens, including our study from last year that was an update called Unequal Pay, documenting some of the government regulations, some of the pay disparities, and certainly the benefit disparities that end up driving some of the government costs and some of the inefficiencies that make it very difficult to amend some of the laws that have locked in pay and benefit, and make it very difficult even for legislators and governors who want to streamline government and make it more efficient to do so. And with that, I'll turn it back to you, gentlemen.
Great. Yeah. Thank you for that, Carol. I was going to actually bring up too the most recent paper that we published. Ken Girardin authored it for us this year, is Connecticut's Lost Decade. And what I took away from it and did in an op-ed for the CT Mirror was, the current recession debate almost kind of misses the point. That it was something like 13 out of 32 quarters in Connecticut. 13 out of the last 32 were negative growth. We had 4 straight quarters of negative growth in the mid 2010s. So it doesn't paint all that rosy of a picture. I was actually happy to hear Fred's point of that young people are tending to stay, because our population growth has been, the third lowest, I think, over the last decade, between the two censuses. Our GDP growth was, we had the lowest growth between 2010 and 2019. The only states that were below us actually decreased in GDP. So that was, pre-pandemic numbers. So there's been a lot of negative forecasts. I know, like, income millionaires are leaving the state in high droves. our per capita income has grown at one of the slowest rates in the nation for years now. So I guess maybe with some of that backdrop in mind, and we've had a couple of questions too come in on the tax front. So I think this is right. One of the highest out migration years for Connecticut was back when we passed the income tax in 91. And I think we certainly haven't seen growth since like that policy was adopted. Is there any, if there were a couple of policy levers that you guys would pull for Connecticut, what would they be as most encouraging and inviting of economic growth for the state?
Well, you want to speak, David?
I'll just do
Dan
the
was
first.
going to say something. Go ahead, Dan.
No, the easiest one and the cheapest one is just eliminate the corporate income tax. The last I looked was $800 million, something like that. If you did that, probably there's a bunch of interaction terms, things that would have occurred in the LLC and the LLP area. And you would end up having a net effect of really reducing the tax burden on the people who are leaving the state with all the jobs. So that would be the cheapest, easiest thing to do, in my opinion. Of course, they won't do it.
Well, the irony is that if we properly funded staffing at the Department of Revenue Services, we'd more than offset the ending that tax with collections. I mean,
You probably get out faster out migration than Fred.
I've done some very simple kind of things, and for instance, sales tax collections are probably $250,000 below where they ought to be, because we have a very archaic way of collecting sales tax. It's basically on an honor system, and companies know that they can shade what they pay, and they know there's very little likelihood of being audited. So, we could improve the revenue front significantly without even cut rates, but improve revenue on that front. So,
I would be shocked if the same group of people who increased the number of auditors would say, "Oh, let's take all the money we pick up and use it to cut the corporate income tax." My own guess is they would take that money, they would pocket the money, and they would give it to their political friends, just like they've been doing for the last.
Well, you're talking to the political dynamics. I mean, obviously there's always.
I can
and
tell
that's-
you someone who's
But
been
that's true. I
audited.
mean, look, that's true on both sides of the aisle. I mean, let's be honest. The horrific tax cut that was put through in the previous administration, $1 trillion went to tax buybacks, and a third of that went out of the country. I mean, it generated no economic benefit that is identifiable.
We had an
So
increase in
both
real wages.
sides, both
We had an
sides
increase
of the aisle indulge in what you're talking about. But what
If-
we're
if-
talking about is what would be good policy. I wanted to make a separate point because you spoke to the sort of the problem of bureaucracy and so on. Connecticut abolished its counties many years ago. And so we have, 169, 172, I forget the exact number of principalities. We call them municipalities. And we prohibit, for all practical purposes, collaboration between towns. So they can't share police departments, they can't share road maintenance. I mean, there's a lot of stuff that clearly ought to be done. And if you look at what happens in other parts of the country, like Louisville merged with Jefferson County because larger geographies are more efficient. Many states, we have huge number of school districts, many of them, well below a minimum efficient size. The entire state of Virginia has, half the school districts of Connecticut, a much larger state. Well, and that permits them to function much more efficiently. So part of the problem with public sector in Connecticut is the rigidity of the institutional structures, and we can't take advantage of the ways in which other parts of the country are able to improve public services and save on cost. So, that's
Fred, I have a
again,
question for you. Is there data? Has anyone studied, you're suggesting making these bureaucracies bigger and more centralized. Has there been any economic, studies done on, does that make them more efficient? Because I'm always going to land on the bureaucracy exists to feed bureaucracy. And, you know, when you talk about stock buybacks not adding economic value, I mean, reallocating capital from inefficient companies, you know, this whole thing about stock buybacks, I mean, investors make decisions about efficiency. They put capital where it's going to be used most efficiently to create economic value. So you know, as again, I'm biased because I grew up in the markets, but the comment and the discussion about stock buybacks to me just completely misses the point. You're just reallocating capital, right?
I'm
Well,
gonna add
that's
my 2 cents.
That's the
Fred.
classic academic argument.
It's
And
not an
the
academic
the
argument.
reality is until
I'm not an
until
academic.
Wait, but
I'm gonna
until-
add my
until
2
nine-
cents, Fred.
Until 1982, stock buybacks were per se illegal because they were market manipulations. And the data is the stock buybacks go overwhelmingly in the first week to the insiders. So it is still, there's very little evidence that supports stock buybacks as really being a way of efficient allocation.
But even if that's true,
I
those
don't
insiders,
sound-
they
but let
reinvest
me
the
ask-
money.
Let me answer your other question. There are serious studies that it's not, you're always up against the question of how you manage things and whether you take advantage of it. But looking at the efficacy, it doesn't say that anything larger is better. That's not the case. Connecticut has lots and lots of very, very small entities, which on a per capita basis appear to spend significantly more on things like road maintenance or police departments or fire departments than would be achievable if they had a responsibility for a larger geography. Again, there's no panacea here, and there's no, across the board. You have to look at each specific area. And again, I'm talking about what might be feasible, not what would be, necessarily because as we refer to the political process. But we could do a much better job.
Allow me to get my 2 cents in here on the national tax cut. The tax cuts led to large drops relative for Black and Latin unemployment relative to white. It led to increases in real take-home pay. This is all pre-COVID. And when you go through the revenue loss relative to that forecast, you discover that it was much less revenue lost. In terms of stock buybacks, if you don't do a stock buyback, you do a dividend. It's essentially a different way to pay a dividend. And I think it has there's no economic effect. Certainly, when we took corporate finance at grad school, they basically said it's the same thing as a dividend. So if you're against dividends, that's fine, okay, but then you're against stock buybacks. If you're for one, you're for the other. There's basically an irrelevancy on the theoretical level. Okay, so in terms of a size of government, and we've seen this thing called subsidiarity, certainly in Europe when they were debating Maastricht and all that kind of thing, where everyone was more interested, where we've learned that when you have a smaller unit, people are closer to it and feel more comfortable funding it. And when you have these very, very large units of government, no one has a clue as to what they're going to do, and no one has any influence over it. And that's when we end up with these large bureaucracies just having their life of their own and wasting money, and there's just no one that's able to control them. So anyway, that's my 2 cents.
Well, so we've had a couple of other questions come in. I had both an email and then here on the Q&A chat. A bit of a hard shift. We could go to like a different topic, and thank you all for that good back and forth. And please feel free to revisit anything that you'd like. Energy costs. So Patrick Callahan brings up the idea, like, shouldn't we be allowing more in the way of pipelines for natural gas? It's something that's readily supplied. It would bring down costs for consumers. And he hears that from his constituents. And then there was another one along the similar vein. Let me see if I can find that real quick. Well, anyway,
You should add in the Jones Act. We should be allowed to import natural gas into Connecticut from Louisiana directly without having to import it from Russia or something like that. So they should certainly give waivers on the Jones Act if you want to, just for the for natural gas transport. The Jones Act prevents ships from outside of the United States to take from one U.S. port and deliver to another U.S. port. So that's been around for a long time. It's a union thing. Were they to give waivers on natural gas, we'd be allowed to import natural gas by boat from Louisiana, as opposed to relying, if we can't get a pipeline done, we could at least always get our natural gas that way.
Yeah, the Jones Act post-World War movement. It's supposed to build, we're supposed to have local industry then of shipbuilding, and it doesn't seem to be working for Connecticut's benefit. Yeah, I think that's a great point. And I actually, as a new homeowner, so I've been a homeowner for all of a month now. And so now I'm looking at, purchasing home heating oil and propane and all of those things. And I know those costs have been high. This morning I drove by the gas station and I saw, let me actually pull up my notes. I actually went to the grocery store to try to do a little market research this morning before this event. And gas was, I think, at $3.40. Strawberries were at $6 for 16 ounces. Ham was $7 a pound. Ground beef was $8 a pound for the only ground beef that was available at the time. Eggs were $5 to $7 a dozen. Milk about $4.50. So I guess those, I think a lot of those costs can be reflective in energy costs too, right? The shipping and moving of those products. Is there anything here in Connecticut that we could do to help? Because I think that would boost the economy in a number of ways of how energy costs were coming down. Are there some other steps that we could take here in Connecticut?
Allow pipelines. You'd have to, sue New York for blockading your state. New York won't let a pipeline go through. I don't know exactly what one has to do to build a pipeline from the Marcellus shale field in Pennsylvania and get that cheap gas to arrive in Connecticut. I'm sure it's a complicated nightmare, or else it'd have been done already, because the price differential between the two places is so high. That's markets normally don't do that. That's a bureaucracy preventing it from happening.
I know back to the Jones Act for a moment. I know Governor Lamont joined several other regional governors in sending a letter requesting an exemption and a waiver from the Jones Act. I don't know where that stands, and I don't know that there's much the state legislature can do, but certainly the federal legislature could here.
Well, we're also talking about NIMBY issues. We have the same issue on electrical supply because our northern neighbors have blocked the completion of supply lines from Quebec, Hydro-Quebec. So it's a lot of individual states are blocking development of, whether pipelines or power lines, whatever. So this is one of the conflicts between, the federal level and the states. And insofar as states have discretion about how they are going to, participate in this, it's, again, a lot of our discussion has been the tension between the way the politics actually operate and sort of our theoretical discussion about what we would be able to do if we had kind of a clean sheet and didn't have to face these kinds of constraints. Absent national policy that addresses this more aggressively, it's hard to see how some of this stuff gets addressed. Again, it's one of these ironies too that we have high, for instance, on electricity, high kilowatt costs, but because historically Connecticut has been high energy costs in the business sector, they've been highly efficient, investing in efficiency for a very long time. We did an analysis a few years ago, and on a GDP analysis basis, we actually had relatively low energy costs when you spread it across our thing. So the individual kilowatt charges were high, but when you looked at the cost as a share of economic output, it was actually fairly competitive. States that have low energy costs tend to be very wasteful about energy. That's sort of in the nature of what you'd expect in economics.
Something about it or something.
It's also the case the high energy cost prevents you from doing data centers in Connecticut. I actually was involved in looking at a project where you take a building and turn it into a data center, and everyone just started to laugh at you. They said, "Are you crazy?" Because the energy costs are too high. So it'd be interesting for someone to do a lawsuit based on the U.S. Constitution, where one of the reasons we did the Constitution in the first place is to keep states from putting tariffs on each other. and allow for domestic commerce among the various states. So that's one of the reasons the U.S. Constitution was written in the first place. And I would think that, it feels like Connecticut is being blockaded on electricity and being blockaded by its neighboring states on natural gas. So I think it would be a fun lawsuit for someone to do.
Well, there's an idea for anybody listening.
And events like this, right? I mean, educating people about these issues so that we all just don't immediately go to our tribal political corners on these issues and think about them using real economic analysis and cost benefit analysis. And exactly, I mean, it's, I'm involved now with we're starting a fund at the university to explore ESG investing. And it's obviously it's a great topic. Everybody is excited about it and what it means, but what does it really mean? What's the cost benefit trade-off? And that's the same thing with energy policy, right? I mean, I read something recently that I think in Connecticut, and correct me if I'm wrong, that 40% of our energy comes from renewables that goes into electricity. I don't know if that's true or not, right? But whatever the issue is, we need to address them, and we need to address them in an objective cost benefit way that sort of takes the politics out of it, because I think that just sort of distracts from the conversation and doesn't allow people to look at it objectively and honestly.
I wanted to make one comment. I got to sign off in a minute to deal with a situation here, but you mentioned the data center and the Connecticut has a very aggressive legislation to try to attract data centers, which is very important. And the idea is actually to get data centers to locate in where we have municipal utilities, because the municipal utilities have energy costs that are like 5 cents a kilowatt. I mean, they're much, much lower than the Eversource. And like Groton has a huge municipal utility, which feeds the nuclear subbase. And so there have been a number of investors that have bought land within the areas served by municipal utilities, precisely because of this energy cost issue to build the data centers. There's only one company, Cigna is the only company that I know of that is building a major data center at this point in Connecticut, but it's something we really need to do. But I'm sorry, I have to go. I have a situation in the household here that I've got to go and deal with, but this has been very, very helpful, and I appreciate the opportunity to participate.
As a father of a
Good to meet you,
3-year-old and a
Fred.
10-month-old, I understand.
Fred, it was good to meet you. Thanks for
Great
joining.
to meet you guys.
Well, I'm sorry that we've had to lose Fred. Emergencies pop up from time to time. Because we actually had a couple of questions come in that I wanted him to be able to address. Carol, is there anything that you wanted to jump in and add to?
Well, I think it would be interesting to talk a little bit more about ESG and to hear Daniel and David's thoughts on this whole new trend of trying to insert really what is essentially political activism into what is supposed to be straight up investing, and how you see this going, what it has meant or might mean for the economy going forward. Would either of you gentlemen care to comment on that? I've been sort of curious about it.
It just means you'll get lower returns. So.
Right. No, it does. But I mean, aside from a lawsuit, do you think it's already had an impact on what people have seen in their returns? I mean, obviously, some of this has been going on,
Normally what people do is they use lots and lots of words, and they don't have lots and lots of actions. So they'll talk, oh yeah, I'm an ESG investor, and they'll take 0.1% of their portfolio and stick it in that, and then they'll tell everyone about how they're ESG this and that. And that's so typically they just lie. Okay. So
you think it's a bunch of virtue signaling, essentially?
No, to the extent that that's what I assume is true. I don't have the data to back it up, but that's just historically when people do this kind of stuff, rather than lose money, they normally virtue signal and then continue with 99.99% of the portfolio doing what makes the most sense economically. So then it's just more and more of that. Now we're walking down the path on climate change where I think that it's starting to have an impact in the sense of wasting money. Like you read about electric cars, and everyone's gonna do this for electric cars and that for electric cars, and you do the total CO2 output of an electric car when you do full cost accounting of the battery and the the machinery and the coal that goes into the car and to make electricity for the car. And you sit there and you say, well, that's a scratch. We know that when we did ethanol, that's actually a net CO2 adder.
Right.
So, and once you start doing ethanol and you have Iowa being the first primary state, then you never get rid of ethanol, even though it makes no sense anymore. So to the extent the Democrats want to move the first primary and turn to South Carolina, there's a chance we could get rid of ethanol. So maybe that's a good idea, actually. So I hear it and I tend to ignore it, and I might be wrong in ignoring it. Just there's so many things going on. Historically, it's just been virtue signaling, just been rubbish. So that would be my first approximation. And if someone shows me data that says I'm wrong, I take them at the word.
My view is if the goal of this trend is for businesses, I mean, one thing I've certainly observed both in my career in financial markets and just watching the investing world is that, sometimes we get lost in, sort of short-term outcomes versus long-term growth and what that means. And that's always a result of incentives in the system, right? So, when I think about what I think ESG should mean, if you tell me that companies, this idea of stakeholder capitalism versus shareholder capitalism, I mean, I think they're the same thing if your goal is creating long-term value for shareholders, right? And, because of regulation and because of the systems we put in place, sometimes we create incentives for people to focus on the short term and not the long term. So we probably should do a better job of that. But absent that, it's just another form of price control, right? Which is going to lead to some sort of. So now we're working on, but now remember, a lot of people are interested in this, and to Dan's point, a lot of it has become about marketing, right? I'm having students look up, how many funds are out there, and then how do you define ESG? So one of the things that I found interesting is that there's been some studies done by both a couple of mutual fund companies that I've done some work with and academics. And in the financial markets, if you look at credit ratings, right, the three big credit rating agencies, their ratings for companies are basically correlated at like 99%. If you start looking at these ESG ratings, they're correlated about 50%. And what the investing world has kind of landed on is, well, we can measure carbon, so we can sort of quantify the E part of it, but the S and G parts is basically people just sort of making things up at this point, and it is marketing. So, we're dealing with it at the school because the reality is our students are going to have to know about this and be part of it, and hopefully the next generation of financial practitioners will sort it out. Again, if the goal is let's manage businesses in a long-term productive way, that's a good thing, right? A little less emphasis on short-term results, but like anything else, putting regulations in place is not necessarily going to accomplish that, right? The market forces still have to sort of dictate that.
Great, thank you. So there were a few. I had a couple in the Q&A ready that I was queued up to ask Fred, because there was a little bit of pushback on a couple of the comments that he made and remarks. But Dan, there was one here directed towards you. It's more China international stuff. So let me know if you have a response. It's from Red Yankee. Which, hello, Red. We haven't had a chance to meet yet. I'm looking forward to doing so. And he writes, if 1B workers in China and India joined the global workforce and saved, and thus drove down interest rates, what now, when China is aging and its workforce is shrinking fast and drawing down their savings? I don't know a response to that question, but if you had something.
It's not for us. We don't care about the number of people that are doing the saving. We care about the quantity of money being saved. So if you have a smaller workforce that's saving more dollars, that's still going to keep the interest rates low. As they age at some stage, which is not happening yet, you would expect them to draw down net national savings as they end up consuming in their golden years. And that would reverse the numbers we saw, especially if their population does not grow, which supposedly it's not supposed to, according to a lot of demographers. It's going to start to shrink. As TFR, total fertility rates, are like 1.5, 2, or below 2. As long as they're below 2, over a long term, population will start to shrink. That's total fertility rate is number of children per female on average. So the replacement number is about 2.1 for most countries. But when you, like Italy at 1.2 and Japan at some very low number like 1.4, you end up shrinking in the long run, not necessarily in the short run, you shrink your population. So the answer to that question is over time that would reverse out. But right now it's still the case, in my opinion, and I might be wrong, that the total amount of revenue earned by these billion people is going up, and if you apply a constant savings rate to that, the dollar amount is going up right now.
And Dan, aren't there other parts of the world that'll sort of fill a little bit of that gap with China, like
Sure.
parts of South Asia? And, God forbid if
Africa.
Africa ever got its act together, right? I mean, resource rich and a lot of people who could come out of poverty and fill that gap.
Sure. No, that could easily happen. It's just, Africa has been a tough one because they just don't grow like the Asians did. Let's put it that way.
So I'll share my screen real quick on just a chart. The topic came up, I think, for both Daniel and David. I was trying to see if I could find this quick.
Wow.
From Fred Economic Data. So quarterly financial report, U.S. corporations, all information, total cash on hand and in U.S. banks. So we saw like that massive spike. I mean, these are a lot of, I think COVID dollars would be a lot of this explanation. And but the trend here now on the back end, this is a really sharp decline. It's kind of replicating here.
I don't know how to interpret that. That is not M2. I don't have a theory on what that does, but that might be a component of M2, and it might be showing you an even, like, we'll call it high-powered M2 for lack of something better to call it. That would be showing what's going on, which is we got a problem coming down the road, but let's see, what are we at? 200, that's 200 trillion? No, that's 200 billion. So the M2 I'm looking at is about 21 trillion. So sure, that could be dropping. Where do I go from 260 billion to 200 and so I dropped $60 billion out of 21 trillion M2. Sure, it's not positive, but it's not an overwhelmingly big number.
Okay. I don't know if David, you had thoughts on that too, because I know both of you had mentioned the banking sector is in a more stable place than it was, and I know part of that would definitely be cash on hand, right? So I noticed that the chart's moving in a different direction than it was.
No, that chart is corroborating the M2. It's just,
Yeah.
The amount might not be sufficient to cause that big a problem for the economy. That's all.
Yep.
Yeah, nothing to add on that.
Okay. Carol, did you have anything else you wanted to raise?
You're on mute, Carol.
You're on mute, Carol.
So now that I've learned to master the very new Zoom technology, well, I didn't know whether, obviously China is facing some interesting economic times, and it's been discussed that, what with their COVID lockdowns that they continue to do and some talk of an economic slowdown over there, et cetera. I didn't know whether Daniel and David wanted to comment on what they think this means for the world economy, what it might mean for the United States, or, obviously we're in Connecticut. So if you think it has some particular relevance to the state, that's of course of interest too.
I'm sorry, I was actually reading one of the questions when you started that comment, Carol. I missed the beginning. My apologies.
It's okay. Just the idea that we've been, hearing about the potential for an economic slowdown in China, and just whatever economic ripple effects you think that might have globally, nationally, or in the event that you think it might have any particular pertinence to Connecticut. How about that? That was very concise, Dave.
If you want to do the bottleneck story as your cause of inflation, the bottlenecks are going to disappear when the M2 goes down. So it's like what's cause and what's effect. So in my world, my way of looking at things, okay, so China's now going to lessen demand. Well, they had lessened demand for commodities, but now China is also going to more easily produce. So to the extent you're waiting on furniture to start up your hotel, which I have a friend who is in that situation that was coming out of China, well, maybe the furniture will actually show up now. To the extent you're looking for some kind of a part that wasn't around, that part will show up, and suddenly we have cars that weren't being taken off the lots and weren't being finished. Those parts will now show up. Right. So that'll get rid of all of those bottlenecks that were running around as China comes out of COVID zero. To the extent the Chinese economy is slowing, that will reduce pressure on commodities. So David, take it away.
I mean, look, China is the issue, right? I mean, the fact that they've become, the second or third biggest economy in the world, right? Obviously still way behind us, but such a key manufacturer, and then just the way they do things, right? I mean, this transformation from, not a transformation, but, they're still a communist society and an autocratic society, and they've become huge players in the global economy. And, I talk about this a lot in my classes, this insanely symbiotic relationship we have, right? The idea that we're at war, I don't look at us as being economic war with China, right? We both need each other tremendously, right? We need the goods that they create cheaply, and then we need them to continue to finance this through their purchase of U.S. securities. And if we wanted to go to war with China, we'd stop buying their goods, which we're not going to do. And if they wanted to go to war with us, they'd basically sell all the treasuries they own, but they can't, right? So how we navigate this in a situation where their form of government is so different, what's going to happen with these protests? I mean, I was shocked to read yesterday that China is actually loosening their COVID restrictions based on these protests that are happening, which, is obviously a great sign, because if their economy tanks, it has ripple effects around the world, but you just don't know how they're going to react to things. So it's a huge science experiment we're watching, and I hope it winds up positive.
The reason they probably, you think they loosened their COVID restrictions because of the protests, and I think that they loosened their COVID restrictions because they don't work. Now, obviously, we can't tell which one's which, but both of them are operating in the same direction.
Well, and I agree with you completely on that point. I mean, they don't work. That's
yeah.
for sure.
So I actually have a national policy way to deal with China, where I had to be the president, and I would do something like, okay, they took over Hong Kong and they said they weren't going to. They're threatening Taiwan, which we don't like. They've got this group of people, the Uyghurs, I think is the way it's pronounced, in their northwest, that they're putting in concentration camps. For American companies, if you don't allow for a joint venture, they won't let you invest. They steal the patents, they break copyrights, they act in a way which we don't think is very kosher, shall we say. So what I would do is I would have a list of things. They harvest organs, they go and kill convicts, steal their organs and give them to party officials who need a heart transplant. I don't even know if that's true or not. I mean, it's just, you read these crazy things that are going on. So what I would do, were I the president, I would say, okay, every quarter until we get some traction, I'm going to add 5 points to the tariffs on China, and I would make it across the board. I wouldn't do any exceptions this way, exceptions that way. Stop when you get to a number that you think is a national security number. 25 to 50% is the right number in my view. And I'll have it happen slowly so that everyone has a chance to change the way that they behave. And then you now have a very nice bargaining chip with the Chinese government, where you are able to have a conversation about joint ventures, about property rights, about patent protection, where to the extent they don't budge, you just keep adding 5 points to the tariffs every quarter and allow Americans to figure out different ways to produce whatever it is that China's producing. And that's what I would do were I the president, and I would probably want more information than Daniel Gressel has, just running his own personal life and not sitting there talking to some experts on the whole thing. But so I would go at that problem that way.
All right. Well, and while you're at it, maybe try and help the Uyghurs out and all the rest of the people China is systematically oppressing.
It's not clear to me that I would use tariffs for that part of the problem.
I know.
I think.
But while you have used your attention getter, Daniel, but at any rate, obviously things would be done a lot differently in a lot of ways if you were governor of Connecticut or running the country or doing anything more than running your own personal life. But we are very grateful, of course, to Fred Carstensen, to Daniel Gressel, and to David Sacco. So thank you to both David and Daniel here in the present, and Fred Carstensen in absentia. And Bryce, I'll hand it over to you.
Yeah, I think that's we ended up far afield from Connecticut, but it all comes back to that at the end. And for everyone that joined us here online today, thank you very much. Daniel and David, if you did have anything last minute please feel free. I'll leave that as a queued up thing. But I wanted to make sure if anybody was interested, you can go to our website, yankeeinstitute.org. You can sign up for our emails if you're already not on it. We publish research and regular blog post updates that keep you informed of what's happening in Hartford and around the state. If you haven't already, you should also sign up for or subscribe to our podcast, Why CT Matters. Carol hosts a lot of great people from across the state and elsewhere, and follow us on social media. Daniel and David, if folks wanted to get in touch with you, is there anything or any last parting advice for anyone? Feel free to offer it now, and we'll wrap up.
You're up first, David.
Sure. So first of all, these events are great, right? Because having a thoughtful discussion about this stuff is so much more informative than a 30-second video or clip. So thank you guys for hosting these events. Kudos to everyone who's on listening. Not that, I necessarily know anything, but when we can talk about these things thoughtfully, we'll get closer to getting real solutions. So thank you guys for doing that. And anyone who'd like to reach out to me, my email address is dsacco@newhaven.edu, and please feel free to reach out anytime you want about any of these topics.
I would like you guys, to the extent you want to reach out to me, go through Bryce and or Carol, and they could forward to me, and then we'll go from there. I get about 300 emails a day.
Daniel, you're a very, very popular guy.
Or I don't have a good spam filter, one of the two. And I would like someone else to cull anything for me. So if Bryce passes it on, I'll certainly take a look at it and try to answer it. But if asking me at the end, I'm optimistic on what's going on with the country. I'm sad that we took $6 trillion and threw it away, and it caused a drop in real income, and everyone got poor. I think Fred is misreading the Trump tax cut. I think it was a fantastic thing. It caused an increase in output. It caused people to onshore a lot of stuff that wasn't being onshored before. It caused an increase in real wages. It caused a decrease in the black-white unemployment differential and the black-white income differential, wage differential. And I think you could ascribe all those things, and taking money, just throwing it away like we did the last few years, has exacerbated all the problems that we have in our
And
society.
it lets you keep more of what you earned, which is yours.
Well, there's also that. That's we'll call that the moral aspect of the whole thing. I'm just trying not to do the moral side. I'm just trying to do what was the economic results of it. There's one of ones out there which we haven't done yet, which is having an open border and allowing 8 million people to come in and take our lower income people's jobs from them. I think it's a shame. I just don't understand why people vote for that. So, but what can you do? We have not enough time to solve all the problems in the world.
No, and of course, we welcome all viewpoints, and both viewpoints as a nonpartisan organization. So we thank you for yours, Daniel.
Okay.
Yeah, thank you both. And apologies to anyone's question we didn't cover. I know there was a few that came up for Fred or were more pension related, talking about what Fred had brought up. So we'll be sure to follow up on those, and perhaps we'll ask more questions along those lines at a future forum. So Carol, if there's anything else, I think that'll do it for us here. Thank you all for participating, and thanks to everyone for listening. We'll have this recording of this on our YouTube page, and we'll share it with everyone in a multitude of ways. So thank you all again.
Thank you very much.
Adios.
Have a great day.
Bye.
Bye.